Hello and welcome to BloombergQuint. We are here to discuss more about what Yes Bank reported late Wednesday night. Essentially, the January-March quarter results came up with a number of details with respect to how the Yes Bank balance sheet has moved after it was put under moratorium by the Reserve Bank of India and the Government of India. Later on, the ownership of the bank was transferred to a clutch of banks as well as HDFC Limited. Now, just to look at what happened with respect to the January-March quarter results, the bank reported about a 2,600 crore worth of a net profit, but this was largely because of a one-off item where the bank wrote off 81 bonds that were there on the balance sheet, and because of that, the profit number could have been recorded. Otherwise, the bank would have reported about a 3,600 odd crore worth of loss for the January-March quarter. Apart from that, of course, on the asset quality side, the bank has shown improvement. Yes Bank's gross NPA ratio has dropped from 18.87 to 16.8%. So that is clearly a sign of an improvement on the asset quality side. However, there are a bunch of other factors that are there behind those numbers. So to discuss this further and to understand how exactly this impacts the bank, we have on the phone line with us Mr. Prashant Kumar, the MD and CEO of Yes Bank. Mr. Kumar, let me first of all start with the profit and the 81 bond number. Now, of course, this writing off of the 81 bonds happened back in March, and obviously that impact has shown in the March quarter results. I just wanted to get a sense, are there any 81 bonds left on the book? Have you completely written it off? And if so, if there are any left, then what are the plans with those?
So we are left with only 280 or 85 crores of 81 bonds, okay, which was issued, which are not covered by the Basel III guidelines, and they have not been written off. So except that, everything was written off, almost 8,500 on 14th of March.
Okay, sir. Just to get a sense of, what that means as far as the bank's ability to raise funding in the bond market is concerned, whether this has created some kind of questions in the mind of bond investors.
No, I think it would be quite difficult for the bank to raise 81 bonds, okay, in this scenario. So I think what we need to do, we need to ramp up our CET, which takes care of the entire 81 structure. And in addition to 81, the Tier 2 bonds. Okay, so Tier 2 bond, I think we are quite comfortable. We are at 4.8% even as of now. Only thing is we are not able to account for everything because we are breaching the regulatory CET. So we are able to cover only 2% out of that in our CRAR ratio. So 81, there is absolutely no plan to go to the market. So we need to go for capital raise in the CET.
Right, sir. So capital raise in the CET, how soon can we expect that? Because back in March, when you had taken over as the CEO of the bank, you had said that it will come up shortly. But of course, a number of events have happened after that. And the country's entire economy has gone through a phase of volatility. Just to get a sense from you, what does this mean? How soon do you think the bank will be able to go out and raise that funding?
So we already have our approvals in place. We have an approval to raise capital up to the extent of 15,000 crores. And we have already appointed the merchant bankers for this. And results are out now, yesterday. So now it would be, we would like to raise it as of yesterday. Okay, so depending on the approvals from SEBI and other regulated entities, and depending on the mode in which we raise capital, but we would like to complete it within the first quarter.
Within the first quarter, that is before the 30th of June?
Yeah.
Okay. And what kind of fundraising will this be? Will this replace the existing banks that have bought stake in the bank? Because, of course, they are limited of their sales. 75% of the equity they can't really sell till 3 years. But how exactly is the structure going to work, sir, for the new investors?
So we have not gone for a particular way of raising capital. Everybody is welcome. But as a strategy, we would like to diversify our investor portfolio. Okay, investor base we would like to diversify. So maybe we'll go for, say, FPO route, or it could be a right issue. It could be a combination of FPO and QIP. So depending on the response of the investors, the advice from our merchant bankers, we will decide this course.
Are you looking at single round of fundraising, or will you break that up, that 15,000 crore?
No, from our side, we would be very happy if we are able to raise the entire 15. But if not 15, then we would be like 10 to 12 would be quite comfortable.
Okay, fair enough. Let me get to the business side of the story, sir. Now, one number that came up, I mean, even before the results were announced, was with respect to the bank's deposit base. Now, between March 5th and March 31st, the bank has seen further outflow of deposits. As of 31st of March, that was about 1.05 lakh crore worth of deposits on the bank's balance sheet. And in the results, you've also mentioned till the 2nd of May, that number has come down further to 1.02. Just wanted to get a sense as to, that movement between the 31st of March and the 2nd of May. How have the deposits changed? What did the retail depositors do? What did your corporate depositors do?
So what we have seen, the deposit after 31st March has more or less stabilized. And we are seeing large corporates and the institutional depositors, because we are always in conversation with them, for their own requirements. Because in the current situation, all corporates and the institutions require money for their day-to-day working. So those monies have been withdrawn for the genuine uses. Okay, but on the retail side, I think during the month of April, we were able to originate the highest number of retail fixed deposit, which is higher than any of the month in the FY20. So that is a very, very positive thing. Number I don't have immediately, but the number was higher than the previous month. So that gives us basically a huge comfort, and we are in constant dialogue with our customers. Like, I am also talking to all my customers on daily basis. So almost 10 to 15 retail customers, I speak to them. Everywhere my feedback is that people are very happy with the customer service. They are very happy the way our people at the ground have taken care of customer during the moratorium and during the lockdown also. And they are also happy with the technology solutions being provided to the large customers. And what you have seen, that not only the retail customer is putting money with us, even the companies or the aggregators who have moved away from us during the moratorium has again come back because of the technology solutions which are available within the bank. So I think gradually, with the type of investors who have come in now, with the support we got from RBI and Government of India, I think this trust of the customer is gradually building up. And we don't expect like this trust would come back overnight. It always happens over a period of time. But that we are seeing in a positive trajectory. Okay.
You disclosed that as of the 31st of March, your retail term deposits were at about 39,000 odd crore. Has that number gone up? Where is that number now?
So that figure I don't have immediately. But the issue is that our focus is more on the CASA side. Okay, because ultimately raising liability, but at the same time controlling the cost of the funds and the cost of liability, that is also very critical. Because we also need to have a decent name going forward, okay, which takes care of any possible credit cost and others. So it has to be a very, very delicate part.
The rates you're offering on your savings account deposits are still very close to what a fixed deposit in other banks would be. Are you looking at tinkering with that at all?
No, we are basically reducing. If you see like 1 year term deposit and above, we have reduced by 25 basis points from 1st of May. So we'll bring down the pricing on our, the rate of interest on our deposits gradually, and we'll align with the market. Going forward, it will not happen immediately.
What about CASA, sir? What about the interest, the higher interest you're offering on savings account deposits?
So that would also come down gradually. Okay, because this in the current situation, I think nobody can afford to pay 5%, 6% on the saving bank side. That would be quite out of the market.
Okay. With respect to your the wholesale deposits now, there was a sharp increase in the certificate of deposits on your balance sheet. Has that increase continued in the current quarter, in the April-June quarter? Are you continuously going out to the market and getting those CDs?
So again, it would depend on it's a mix of the liability. Okay. So if we see some good opportunities on the lending side, then we would not hesitate in raising additional resources on the CD side also. So it's a trade-off between what is your requirement and what is the cost and how profit you would like to make on all those.
Okay, fair enough. Let me move on to the asset side of the story. You reported about a reduction in your gross NPAs from 40,000 odd crore to 32,000 crore, 33,000 crore. Most of this reduction is largely because of what you define as technical write-offs, about 6,300 crore. Just trying to get a sense, I mean, already the bank has written off a sizable chunk. There is still about 33,000 crore worth of bad loans on the books, plus of course SMA1 and SMA2 accounts, which could, we can't really say how many of them are going to be NPAs, but they are at risk. What is your expectation as far as these technical write-offs are concerned? Is your reduction in NPA going to be preceded by the technical write-offs, or will you focus on recoveries and upgrades?
So basically, if you see the technical write-off, this is always done with the objective to manage your balance sheet. Okay, there is it does not make any difference as far as your focus on the recovery out of these NPAs are concerned. Your focus remains the same, but once you do a write-off, you get some tax exemption, then you are able to get some benefit in terms of your DTA and other things. So that is the only purpose. Otherwise, by technical write-off, the objective is not to reduce the gross NPA. To be very frank with you, we are more focused on net NPA number. Gross NPA numbers become sometimes irrelevant. Okay, so if you see by increasing the provisions, we are able to reduce our net NPA to 5.03. I think that is more relevant and realistic.
Okay. As far as your corporate debt securities book is concerned, there again you said about 64% of that book is classified as NPI or non-performing investment. Just trying to get a sense of, what are the ratings there? I mean, it's largely dominated by two groups. One is the housing finance company that we all know, and second is a conglomerate, as you mentioned in your analyst presentation. But what is the rating situation there now? I mean, you have taken the hit, but are they all default papers?
No, so basically wherever these have become investment, what happens when you take exposure on the loan side of a entity, there are occasions where you also take exposure on their bonds. Okay, so when there is a default on the loan side, your investment also becomes the NPI, irrespective of the rating. So you may be getting 20 cents, you may be getting 40 cents, but since the loan has become non-performing, the relative investment also becomes the NPI, irrespective of rating. Okay. So if you see on the investment side also, we have increased the provision coverage up to 74%.
Sure. You said that the irrespective of the rating of the paper, it still becomes an NPI. What is the rating now? I mean, what is the breakup there? Because you've given a breakup for the rest of the book, but
so in this case, it's a mix. Okay, so 74% coverage is we have basically built up this provision depending on what is the market price of these securities. Okay, so basically this provision takes care of the LGD out of the investment also.
Okay, so the LGD, the loss given default there is 74%, is what you're saying?
Yeah.
Okay, and do you need to increase that in the time ahead? Does your estimate say that?
So it would depend on what would be the market rate for these securities going forward. Okay, if the market rate further worsens, And if there is a need to make further provision, we'll do that. Or if there is an opportunity, we will try to come out of that.
Okay. Another important point that it has become relevant in the last month and a half is what has happened with respect to COVID-19 and the moratorium that the RBI announced. Now, in your analyst presentation, you mentioned that about 10 to 15% of your corporate borrowers by number and MSME borrowers by number as well, they have chosen to go for the moratorium. And about 20 to 25% of the retail customers have number of retail customers have gone for the moratorium. Trying to get a sense of what is your expectation as far as their future ability, because by 31st of May this moratorium ends. The ability of these customers to pay back after that 31st of May, what does that look like?
So to be very frank with you, if this moratorium is not extended, and if any one of us is thinking in terms like that these customers would come back on 1st June and would repay the entire, say, installments and the interest together, then I think we are making a big mistake. And this is not about the Yes Bank alone. This is for the entire banking industry. It could be X percentage for me. It could be X plus or X minus for somebody else. Okay, but since there is no economic activities for last 2 or 3 months, so these customers coming back on 1st June and paying the entire thing, at least my understanding, it is not going to happen. So I think there is a need for some more dispensation. Yeah. So dispensation, and we would be suggesting like dispensation not only in terms of the repayments of the principal, but also in terms of the capitalization of interest. If there is no economic activity, no income generation, and if we expect like interest would also be repaid on day one, I think this is something which is not going to happen.
Okay. Coming to strategy side of the story, in your results disclosures, you've said about 44% of your loan book is now retail. Trying to get a sense of how exactly are you going to grow that book now, advances in general. You have seen a considerable amount of reduction on the asset side, on the corporate loan book. How do you plan to grow this forward? Is corporate still on the radar as far as growth is concerned?
So our focus would be still a continuous focus on reduction on the corporate side. Okay. I'm not saying to the extent which has happened in the past, but yes, going forward, there would be a continuous reduction on the corporate side. And on the retail side, we would grow around, say, 20%. So that would bring my, say, proportion on the retail, and which is SMSC and retail, around 60%, say, over a period of, say, 18 to 24 months.
Okay. Is there any specific segment that you're looking to completely exit as far as loans are concerned?
No, it's not like this, because getting out of these loans would happen only if we are able to sell it down to some other bank or financial institution.
Yeah.
Okay, so immediate concern for us would be more about the balance sheet management. Okay, but at the same time, we also need to retain those assets on our books, which gives us good return. Okay, so wherever like we'll see the rate of interest is not remunerative for us, there is a buying from other banks on this, we would be happy to sell those assets.
Yeah. In your disclosures, you've also mentioned about certain investigations that are going on with respect to legacy issues at the bank. What is the proportion of loans that is being investigated at this point in time? Whether for any kind of malfeasance or any kind of quid pro quo, any other situation, what is the proportion of the loan book that is considered currently under investigation?
So it would be difficult to say about the proportion, but I think the entities and the groups which are well known in the public domain, so there were a large number of complaints related to those accounts and the entities, so which are being investigated now. But these are well known in the public domain.
This is being done by external agencies, but internally, what is the bank doing?
So we are doing it internally also, and along with this, we are taking outside professional help like auditors and others. And there are certain cases where even the external law enforcement agencies are doing their job. So it's a mix.
Does any of this put a shadow on your liabilities plan, growing that liability base, because trust is an important factor when it comes to liabilities?
No, I would not think. So it is not like anything will come out now. So all those accounts are already NPAs where the provision has been made. It's only about finding out whether there was any malfeasance, whether there is a quid pro quo or other things. But other part has been taken care of.
Okay. Lastly, sir, with respect to your growth plan, your capital raising plans that you mentioned earlier, you would like to close it by the 30th of June. What are the kind of investors that are you targeting? Are you already in talks with certain investors? What is the response from the RBI looking like?
So we have not gone to that stage. We were getting interest from large number of institutional investors. Okay. But since everybody was waiting for our results to come, and now results are out yesterday, we have appointed the merchant bankers. They would be talking to them, finding out what exactly that is there in their mind, and then we can reach out to a solution.
All right, Mr. Kumar, thank you so much for joining us and clarifying all of these points. And thank you so much for watching. Please do log into BloombergQuint for other information with respect to Yes Bank and other companies in the market.